Alright, let's talk about UnitedHealth Group, ticker symbol UNH. This stock has been on quite the roller coaster lately. Over just the past month, the share price has exploded higher, climbing more than 40%. To put that into perspective, if you had put $1,000 into the stock a few weeks ago, you'd already be sitting on over $1,400 today. And even in today's trading session, before the market closed, UNH was still pushing up another 8%. That's some serious momentum. If we check the scoreboard of the best performing stocks in the S&P 500 during August, UNH actually took the silver medal. It ranked number 2 overall, rising about 24% that month alone. That's impressive company to be in, especially considering the S&P 500 is made up of 500 of the biggest and most important companies in the US. But here's where the story takes a turn. If we zoom out beyond this short-term rally, the picture looks very different. Year-to-date, UNH is still down more than 30%. And if we stretch it back over the last 12 months, the stock has lost over 40% of its value. So yes, the recent rally looks exciting, but long-term investors are still feeling the sting of a rough year. This is a great reminder for beginners. The time frame you look at can completely change your perception of a stock. A 1-month chart might make something look like a rocket ship, but a 1-year chart can reveal it's actually been tumbling for months before bouncing. It's like zooming in on a mountain hike. If you only look at the last stretch, it feels like you're climbing fast, but zoom out, and you might realize you're still deep in the valley. Now, in the past couple of weeks, a flood of new headlines has been swirling around UnitedHealth. Some of the updates are negative, while others are more optimistic. That's what makes this stock so interesting right now. Investors are asking whether this rebound has real staying power, or if it's just a temporary pop before more turbulence. So the big question is, given everything happening with UnitedHealth, the rally, the news, and the bigger picture, is there still opportunity here for investors, or is the bounce already overdone? Let's break it down. Before we even get into the fresh headlines, let's rewind a bit and talk about why UnitedHealth stock has been hammered so badly over the past year. Because if you just look at the short-term rally, you might think everything's fine, but the deeper story explains a lot. The best place to start is with earnings per share, or EPS. For anyone new, EPS is just a measure of how much profit a company makes divided by the number of shares. Think of it like slicing a pizza. EPS tells you how big each slice is for shareholders. From 2014 all the way through 2023, UnitedHealth had what I'd call a dream chart. Their EPS just kept climbing year after year, no big dips, no scary swings, just steady, reliable growth. For investors, that kind of consistency is like music to the ears because it shows the business is both profitable and dependable. But then came 2024, and the music stopped. Earnings fell off a cliff, dropping from about $24 per share to just over $15. That's not a small slip, that's a major hit. And the reason was unusual, a massive cybersecurity attack. At first, the company told investors, "Don't worry, this is a one-time hit, we'll bounce back." That sounded reassuring, until more bad news piled on. Within months, UnitedHealth lost its CEO unexpectedly. The Department of Justice launched an antitrust probe, the company posted a brutal first-quarter earnings report, lowered its guidance for the rest of the year, and, as if that weren't enough, got hit with a criminal fraud investigation by the DOJ. That's a lot of body blows in rapid succession. No wonder the stock tanked from around $583 a share in mid-April to much lower levels. For a company this size, with a massive market cap, that kind of drop is rare and shows just how shaken investors were. Now, here's where the story gets more interesting for long-term investors. Historically, UnitedHealth hasn't just been a growth stock, it's been a fantastic dividend growth stock. Dividends, for beginners, are basically cash payments companies give shareholders as a reward for owning the stock. And with UNH, those dividends have grown consistently because their free cash flow, the money left over after paying expenses, has also been climbing. Free cash flow is key because without it, dividend growth is just smoke and mirrors. Right now, the dividend yield is about 2.4%. That might not sound thrilling until you put it in context. For most of the past 5 years, UNH's yield hovered between 1% and 1.5%. The recent sell-off pushed it above 3% at one point, which was unusually high for this company. Now, after the rebound, we're back to about 2.4%. Still, that's well above its normal starting point. And the real kicker? The dividend itself has skyrocketed over the past decade. Back in 2014, the payout was just a little over $1 per share. Today, it's more than $8.50. That's a six-fold increase in just over 10 years. Growing dividends that quickly while also delivering steady business performance is the mark of a high-quality company. So here's the puzzle. UNH is clearly capable of rewarding long-term shareholders through consistent dividends and cash flow, but the combination of a cybersecurity shock, leadership issues, and government probes really knocked the stock off balance. That's the tension we need to keep in mind as we weigh whether this rebound has staying power. Alright, so now that we've covered the background, let's fast forward to what's happening right now. What's the latest news around UnitedHealth? Because a stock doesn't jump 40% in a month for no reason. Let's start with the not-so-great stuff. Back in late August, we learned that the Department of Justice is widening its investigation into UnitedHealth. Originally, people thought the probe was focused only on how the company handled Medicare, that's the government-backed health insurance program mainly for older Americans. But the latest reporting suggests the investigation may also include how UNH reimburses doctors and even how it manages its pharmacy benefit manager, Optum. For beginners, a pharmacy benefit manager, or PBM, is basically the middleman between drug makers, insurers, and pharmacies. They negotiate drug prices and decide which medicines are covered by your insurance. It's a huge and controversial business, so anytime regulators sniff around, Wall Street pays attention. Now, it's important to note, the DOJ hasn't accused UnitedHealth of wrongdoing. Nothing has been proven. But the fact that the scope of the investigation is broader than people thought adds a cloud of uncertainty. And that wasn't the only piece of negative news. Around the same time, another report came out saying UNH was facing pressure over the loans it gave to healthcare providers after that big cyberattack earlier this year. Their Change Healthcare unit, which processes medical claims, got hit hard, causing delays in paying doctors and hospitals. To smooth things over, UnitedHealth gave loans to providers while payments were stuck in limbo. That helped in the short term, but it's created some debate about whether those loans were fair or sustainable. Again, not a headline that crashes a stock on its own, but it adds to the list of things investors are watching. Alright, enough with the gloom. Let's flip over to the good news, because clearly something positive is driving this rebound. The biggest piece of good news, UnitedHealth just reaffirmed its annual earnings outlook. In plain language, earnings outlook is management's forecast for how much profit the company expects to make this year. Earlier in the year, right when the stock collapsed, they cut that guidance, and when companies do that, investors panic because it signals uncertainty. Nobody likes uncertainty. But now, the company is saying, hey, we're on track. They're projecting adjusted earnings of at least $16 per share and revenue between $445 and $448 billion. Analysts were expecting about $16.24 per share in earnings on roughly $448 billion in revenue. That means the company is lining up nicely with expectations, not missing, not undershooting, but showing stability. And stability is like gold when a stock's been through chaos. Why does this matter? Because when investors try to figure out whether a stock is expensive or cheap, they look at valuation, how the current price compares to expected earnings. If a company has a solid earnings forecast, it makes it easier to calculate whether today's stock price makes sense. And there's even more good news. UnitedHealth recently got an upgrade on its Medicare star ratings. Quick explainer: Medicare star ratings are scores the government gives to Medicare Advantage plans, kind of like Yelp reviews for insurance. Plans rated 4 stars or higher are eligible for annual bonus payments, and the higher the rating, the bigger the bonus. UnitedHealth announced that roughly 78% of its members could be enrolled in 4-star or higher plans for the 2027 payment year. That's a big deal because it means more bonus payments, more credibility, and a stronger competitive position. Now, this rating isn't final yet, but the early data is encouraging. Combine that with reaffirmed earnings guidance, and you can see why investors have rushed back into the stock over the past month. So on one hand, yes, the DOJ investigation and the cyberattack fallout are real risks. But on the other hand, the company is showing signs of stability, financial strength, and potential growth through Medicare programs. That's the tug-of-war investors are trying to figure out right now. Now let's shift gears and talk about valuation. Basically, is this stock still cheap or expensive after that monster 40% rally? Because let's be real, when a stock jumps that much in a month, the first thing investors wonder is, did I miss the boat? To figure that out, I pulled up some numbers and ran what's called a sensitivity analysis. That's just a fancy way of saying, let's test a few different scenarios to see how things might play out in the future. Here's what stands out: UnitedHealth has a long history of growing earnings at a really strong pace. And if we look forward, Wall Street analysts still expect that growth to continue. From 2025 through 2029, the average projected growth rate for earnings per share is about 16.5% a year. Now, if those projections are even close to right, that's a very healthy growth rate. Companies growing profits at double digits usually command pretty high valuations. And that brings us to the price-to-earnings ratio, or PE ratio. This is one of the most common ways investors value a stock. All it does is compare the stock price to the company's earnings. A higher PE usually means investors are willing to pay a premium for future growth. Over the past decade, UnitedHealth's average PE ratio has been about 23. That's not crazy for a business growing earnings this quickly. But here's the twist: right now, after the sell-off, the trailing 12-month PE is just under 15. That number's a little misleading because 2024 earnings were unusually low thanks to the cyberattack. Still, the takeaway is clear: even after the rally, UNH is trading at a valuation that's much lower than its historical average. So let's play out a scenario. Imagine the company keeps growing earnings at around 16.5% per year and eventually settles into a PE ratio of, say, 18. That's still well below the 10-year average. In that case, by 2030, you'd be looking at a total return of about 80%, not even counting dividends. That works out to roughly 10% per year compounded, which is comfortably above the long-term market average of about 7 to 8%. Now, what if the stock goes all the way back to its historical PE ratio of 23? In that case, you'd be looking at a return of more than 120%, which translates into annualized gains of around 14%. That's a very strong outlook for a company this size. So from a valuation perspective, the math is pretty convincing. Unless these growth projections turn out to be way too optimistic, the stock still looks undervalued, even after the rebound. That's why a lot of long-term investors are starting to take a fresh look at UNH right now. So, after all this, what's the real concern that still hangs over UnitedHealth? Honestly, it still comes back to that Department of Justice probe. Until we get clarity on what regulators decide, there's always going to be some uncertainty. But here's where things get really interesting. One of the biggest names in investing, Warren Buffett, recently bought shares of UNH. And that matters, because Buffett has spent his entire career emphasizing the importance of trustworthy management. His philosophy is simple: only invest in businesses where you believe in the people running the company. So, if he's confident enough to put Berkshire Hathaway's money into UNH while this investigation is still unresolved, that's worth paying attention to. And Buffett isn't the only one stepping in. Congressional trading data shows lawmakers have been buying more UNH shares recently than they typically do. On top of that, I track the so-called super investors, those top fund managers and billionaires who move huge amounts of capital. In the most recent quarter, UNH was the single most purchased stock among that group. That tells you a lot about where big money is flowing. And here's the kicker: insider buying. Insiders are the executives and board members who run the company, the people who know the business best. In 2025, insiders bought more UnitedHealth stock than they did in all the years from 2007 through 2024 combined. That's a jaw-dropping level of confidence. If they were worried the DOJ was about to drop the hammer, they probably wouldn't be putting their own cash on the line like this. So here's where we land. No one can predict with certainty what regulators will find. That risk is real, and it's not going away until we get answers. But when you see Buffett buying, super investors loading up, lawmakers showing interest, and insiders piling in, that's a powerful signal that a lot of smart money is betting on a recovery. And from a numbers perspective, the case is still strong. If UnitedHealth simply delivers the average earnings growth that analysts expect and trades at a reasonable valuation, not even back to its historical highs, the stock still looks undervalued today, even after that 40% rally. Of course, the risks are there. This isn't a risk-free bet. But the potential upside is why so many investors are watching UNH closely right now. So, what do you think? Are you considering buying shares of UnitedHealth, holding off until the DOJ news clears up, or maybe even taking profits after this rebound? Drop your thoughts in the comments. I'd love to hear how you're approaching this one. Thanks so much for tuning in, and if you found this breakdown helpful, make sure to hit that like button and subscribe to the channel. We've got plenty more deep dives coming your way.